China's slow economy seems set to go even slower in 2026. Commentary. As 2025 draws to a close, it might be a good time to take stock of China's troubled economy and assess its prospects for the new year. The picture is mixed, as is always the case for China and other economies. Although there are some positive signs, many of the problems that have plagued China for some years remain unresolved, most notably the ongoing property crisis. The prognosis is that the slowing so evident in recent months will likely dominate in 2026. One item on the favorable side of China's economic ledger is the news that major property developers, after a long delay, have at last begun to rationalize their once chaotic finances. Debt rescheduling has already started in earnest and is a good first step in turning decline into recovery. It is, however, only a first step. It will take at least 2 years before this important sector can begin to support China's economy. Another economic boost should also emerge from the recent agreement between Chinese leader Xi Jinping and U.S. President Donald Trump, which allows China to avoid the worst of Trump's threatened tariffs and other trade restraints. Also on the positive side is Beijing's decision to invest billions in what it refers to as the industries of the future: semiconductors, biomedical products, artificial intelligence, electric vehicles, batteries, and quantum computing, among other frontier technological pursuits. Although this effort has run into some troubles, it cannot help but add to growth. Hinting at another source of growth momentum, the latest 5-year plan has given priority to reviving the Chinese consumer. Still, serious questions about the nation's economic and financial prospects remain. At the top of that list is the ongoing property crisis. The recent financial rehabilitation among large property developers will give them the flexibility they have lacked since the crisis broke out in 2021. Still, before they can turn decline into growth, they must sell off, no doubt at a loss, the poorly conceived and now largely empty apartment buildings they constructed during the boom years prior to the COVID-19 pandemic. Major property developers will also need to complete the apartments they had pre-sold but never finished because of their financial troubles. Only after they take these steps, which S&P Global Analysis estimates will take until 2027, can property development make a positive economic contribution to growth. Although Beijing's exuberant investment in technologies has added to growth since 2023 and will likely do so in 2026, it has limits. For one, the technology sector constitutes only about 10% of the economy and so cannot fully offset losses in the property sector, which at its peak accounted for about 25% of the country's gross domestic product. What raises even more serious questions is the uneven nature of this technology investment boom. The growth in the capacity to produce these high-tech products has outstripped China's domestic needs, creating deflationary pressure that has generally brought down producer prices by more than 5% over the last 2 years. Deflation itself retards growth prospects by inducing households and businesses to delay spending on the expectation that they will get lower prices in the future. Beijing's investment has created yet another problematic imbalance. The push in quantum computing and AI has outstripped China's ability to produce the advanced computer chips these efforts need. It does not help, of course, that American export restraints have cut off China's ability to supplement domestic chip production with imports of advanced chips from, say, the US-based NVIDIA. The shortage of chips in China has forced workarounds and even impelled Beijing to get involved in the allocation of the output from China's premier chipmaker, Semiconductor Manufacturing International Corporation. The shortfall and workarounds have slowed and made the technology effort less efficient and more prone to error. Meanwhile, the surplus of production capacity in areas of technology other than semiconductors, most notably EVs and batteries, has increased China's dependence on exports. In the past, such a development might not have been a problem. Still, now the economies need to sell abroad faces considerable hostility from the United States, Europe, and even in the developing world, most notably Indonesia, Malaysia, and Mexico. And though Xi and Trump have agreed to some reduction in U.S. tariffs on Chinese imports, those levies remain high, above 40%, in fact, and much higher than in 2024. Although the most recent 5-year plan emphasizes the need to help the Chinese consumer, it fails to include the broad-based support that the economy needs. The most Beijing has done is subsidize purchases of autos and household appliances, a move that has to rate as small beer next to the general squeeze on household budgets. The biggest problem in this area comes from the downward pressure the property crisis has put on residential real estate generally. Because of the previous overbuilding and the lack of financing in the area since 2021, residential real estate prices have fallen some 20% since the start of the crisis. Since most household wealth in China is tied up in the family home, these real estate price declines have hit family net worth hard and constrained spending accordingly. The Chinese consumer will not return until this situation turns around. Subsidized appliance sales are far from enough. This array of adverse pressures has brought little cheer to China's economy in the second half of 2025. The growth pace of industrial production has slowed by almost a third since last spring. According to Beijing's National Bureau of Statistics, the so-called PMI index of manufacturing activity hit a value of 49.0 this past October, the most recent period for which data are available. Anything below 50 signals a decline. Though the services twin of this index did show expansion, the slow 4.6% rate of advance in sales of services was considerably slower than earlier this year or in 2024. Retail sales in October showed a meager 2.7% gain over the same time last year. Especially noteworthy was the outright decline in auto sales, indicating that Beijing's subsidy program, already too small to solve the general problem, is losing its effect, even in its narrow area of focus. Online sales rose smartly, but less from a general sign that the consumer was expansive then because they stole activity from other retail outlets. And, unsurprisingly, exports fell during this time. Sales in the United States came in 25% below year-ago levels. Sales through Beijing's Belt and Road Initiative offset this loss somewhat, but overall exports still fell by 7% from year-ago levels. These recent data flows and the problems behind them impart a definite negative tilt to the growth prospects from 2026. The negative tilt might shift upward if Beijing acknowledges the need for a broader-based stimulus program, especially for the Chinese consumer. Still, the recent 5-year plan suggests that there is little likelihood of such a move. China's economy is large and diverse enough to make outright economic decline unlikely, but still, slower growth seems to be in the cards.